What's up, guys? Welcome back to another day trading video, and today we're gonna go over fair value gaps. So I'm gonna be doing my whole strategy from start to finish, all right, and then I'm gonna do it all on board first, and then I'm gonna redo it on the computer, so on the chart, so that you can be able to see it on the charts, which is like way better. But I want to get it on board so you can actually understand it better. So it's easier to see on the charts, but better to understand, in my opinion, when written down. So step one is to find your daily bias. Step two, find the liquidity. All right, we have gone over that. Now step three is understanding fair value gaps and also understanding inverse fair value gaps. Step three is really a break of structure. And how do we find those break of structure? With inverses and gaps. But first, we're gonna understand gaps. Then onto the next video, we're gonna understand break of structure. But first, all right, let's just go into fair value gaps. All right, understanding fair value gaps. So what are fair value gaps? Well, fair value gaps are three candlestick patterns with imbalanced price action with either more buys or sells in that area. Sorry, we're gonna find a specific three candle pattern. All right, three candles. We need to find three candles, and they need to make a pattern, something that always happens. Not always, but something that happens that always happens. If that three pattern candle happens, then we have our fair value gap. And I'm going to tell you what exactly we need to find that always happens, that always needs to happen for that fair value gap to be formed by a three candle pattern. All right. But first we have to understand there are many different variation of fair value gaps. All right. We have new day opening gap or a new week opening gap. We have candle gap, and we have inverse gaps. All right, so let's go over very simply fair value gap. All right, on the left side we have a bearish fair value gap, and on the right side we have a bullish fair value gap. So when we have a bearish fair value gap, that's indicating bear movement going down. All right, a fair value gap, that means price action is going down. When we have a bullish fair value gap, we have indication of a fair value gap that's going to take us up, that's going up. All right, so we have to identify this by finding a three candlestick pattern. By understanding the first candle bottom for a bearish fair value gap, or top for a bullish fair value gap, wick 2, the third top for a bearish fair value gap, or bottom for a bullish fair value gap wick. All right, so from the bottom wick to the top, from the bottom first wick to the bottom, from the top, sorry, third wick. And for a bullish, from the top first wick to the third bottom wick. All right, that is how we understand a gap. Once there is a gap in between that area, then we have a fair value gap. If a wick was made like this, we have no gap. There is no gap. All right, there is price going in here. That's not making a gap. All right, there has to be no wick in that area. There has to form a gap. And it's better to show you on charts, but I hope you understand right here. A lot of people understand it, but this is the candlestick pattern you want to be looking for. For a new day week, or new day or a week opening gap, or a candle opening, you want to look for a gap just appear. There's no candles in that area. All right, so new day, we end the day on this candle. Then markets open back up. The markets are 23.5. All right, they close at 5 and then reopen at 6. From that 5 to 6, there's no trading. From the 5 p.m. mark to the 6 p.m., there's no trading in that area. So once 5 o'clock hits, trading is done. All right, trading is done. And what happens? We form this gap that sometimes goes up or goes down. So a bearish will indicate price just teleported down. A bullish is when price teleports up, and we have this gap. The same with a fair value gap, from the first candle bottom or top wick to the third candle top or bottom wick, as you can see right here. But not necessarily third, because there's no middle candle. So when a new day opening gap happens, it's just from the first to the second. All right, there's not really a three candlestick pattern is only for a fair value gap. This is a new day week opening gap or a candle gap. All right. So make sure to look out that. And we're gonna explain why these gaps are useful very quickly. But then we have the last one, inverse gaps. So a candle must close out of the fair value gap, and then we have order flow that is now going to the opposite direction. This helps us tell that the order flow is going to the opposite direction where price is going. Price was previously going bullish, but it inverse this gap to tell us now it's going bearish. All right, how are we going to identify this? We find our gap first. Once the candle forms out of this gap by breaking this gap like this, not with a wick, but with the candle body formed, then we have an inverse. If it just wicks, then it respects the gap and it's telling us that, hey, we are still going down since this is a bearish for value gap. And same thing for a bullish. If it closes down, but not a wick, just forms a candle, then we have an inverse. If it was just a wick, that's telling us buyers bought it back in this area because it's a bullish fair value gap and we are still going in a bullish momentum. But if it closes, then we have bearish momentum from that bullish fair value gap. The bears were like, we're gonna take over. The bulls were too weak, so price decided to go down. And same thing with the bullish. So what if there's multiple gaps, multiple fair value gaps stacked up on each other, right? Because I've been seeing a lot of people get confused and don't know what to do if there's multiple fair value gaps. What if it just hits one? Does that mean, are we still gonna go up? What if it just hits like 3 out of 5 fair value gaps? Are we still gonna go up? We have to understand this. All of them are valid. All of them are still indications that we have a lot of buying and or selling in that area depending on the fair value gap. If we have a bullish fair value gap, there was a lot of buying in that area. So once price hits that area, we might tend to want to buy back and go right up. For bullish, the exact same thing, but except sells this time. So how do we distinguish which one? Like, how do we distinguish if it works or not? Every fair value gap works, but order flow starts going in the opposite direction once only if the last fair value gap got inverse, then that confirms order flow is going in the opposite direction. So if there's 5 fair value gaps and they all got inverse, we're confirming that order flow is going in the opposite direction. If 4 out of 5 fair value gaps get inverse, that can indicate strong momentum to the opposite side. But I would be careful because there's still one more fair value gap that needs to get inverse in order to confirm that order flow is going in the opposite direction. All right, so that's what you want to make sure you see all fair value gaps. If you see a fair value gap, sorry, no charge. Now, what can we use this for? What can we use fair value gaps for? Why is it useful? Well, it's for confirming where order flow is going. Does it respect or disrespect the fair value gap? What happens? Are we respecting that fair value gap or disrespecting it? If we're respecting it, we're confirming order flow is continuing to that direction. If we disrespect it, then we're confirming that order flow is going to the opposite direction. Now, keep in mind, disclaimer, because they get inverse or respected doesn't necessarily mean 100% of the time they're gonna work. All right, price can do whatever price can do whatever it wants. The markets are very complicated and confusing and unpredictable, but we can use techniques like this, ICT, things like this, in order to help us know where price is going. All right, or to know where price is going. Literally what I said, or to know where price is going. All right, we're going to use this to know where price is going. Now, fair value gaps is one of the things I use. Now, actually, I don't use fair value gaps as often. If I see a fair value gap while I'm in a trade, that's a strong indication that my trade is going to work, and I love it. But the thing I look out for is inverse fair value gap. If I find an inverse fair value gap, that means a break of structure to the opposite side. Once it hits liquidity, then I know we want to deliver from that liquidity going to the opposite side. And how do I use that? With an inverse to help me confirm that price is going in the opposite direction. Why? Because inverse indicates an order flow is now going into the opposite direction. Because it ignores the sells or the buys in that area and pushes through. For fair value gaps, I use it as, hey, price might want to respect that fair value gap. It might want to test it. So if I see a fair value gap, we might want to test that fair value gap. I use it on the 4-hour. I explained it on my daily bias analysis video. Please check it out. And for new day opening gap, the exact same as fair value gap. Once a new day happens and a opening or new day or weakening or candle gap opening happens, price tends to want to go back into that area to test it out. It doesn't matter if it's going to respect it or disrespect it. I most of the time usually want to see if it will go back into the area, and most times 8-9 times out of 10 it does exactly that. It tests that area. I don't care if it disrespects it or respects it. Sometimes once it goes into this area, I would like it to disrespect it, but disrespect it or respect it so I can take a trade out of it, but that is using it as liquidity. And fair value gaps are not liquidity. They can be used as magnets because there's a lot of buying or selling or buying in that area, but I would stick to liquidity. That's just me. But you can do the exact same thing. Fair value gaps work like that. And yeah, that's it for today's video, guys. I hope you enjoyed the video. I'll catch you guys into the next video. Please like, share, subscribe, and share with all your friends so you can learn how to trade. I'm gonna be honest, it is good to be back. I haven't made a video in a long time. I'm sorry about that. Some things happen. If you watch my video on how I made or not, I don't want to jinx it a lot. No, how I made money, because I think I'm gonna upload this on Friday, maybe Saturday. Then you'll see why I was gone for a while. But it's good to be back. I love you guys. Thank you so much for 100 subscribers. I'm gonna stop yapping. I'll see you guys in the next video. Peace.